Why do basis traders make expensive errors? Imagine trying to hit a moving target while blindfolded. That's often what basis traders face. They aim to profit from the difference between a commodity's spot price and its futures price, but mistakes can cost a lot. Basis trading involves taking opposite positions in the spot market and futures market at the same time. The goal is to profit when the gap between these prices narrows or widens as expected. The basis is simply the spot price minus the futures price. When spot prices are higher than futures prices, it is called backwardation. When futures prices are higher than spot prices, it is called Contango. Both situations reflected different market conditions like demand, supply, storage costs, or interest rates. One common reason basis traders make costly errors is incorrect forecasting of how the basis will move. To predict this, traders need to understand supply and demand, storage costs, interest rates, and seasonal factors. If they misjudge these, they might take the wrong position. For example, unexpected weather changes or geopolitical events can shift supply or demand suddenly, throwing off their predictions. Another mistake comes from ignoring market liquidity and execution risks. Large trades can cause slippage, which is when the actual trade price differs from the expected price. If the bid-ask spread widens or the market becomes less liquid, traders might not be able to close their positions at the planned prices, leading to losses. Carrying costs and storage risks are also often underestimated. Holding physical commodities to hedge futures positions involves costs like storage, insurance, and financing. If these costs increase unexpectedly or are not properly calculated, the profit from the basis convergence can disappear or turn into a loss. Leverage is another factor. Many basis traders use borrowed money to amplify gains, but if the basis moves against their position, losses are magnified. This can lead to margin calls or forced liquidation, which are expensive mistakes. Structural changes in the market can also cause errors. Changes in regulations, supply chain disruptions, or new market participants can alter the usual basis relationships. Relying solely on historical patterns without adjusting to current conditions can lead to big surprises. Physical hedgers like producers or processors must match their physical supply with futures contracts carefully. If they mismatch the timing or quantity, they risk exposing themselves to price swings instead of protecting against them. In essence, these costly errors happen because traders overestimate how predictable the basis is, underestimate risks, or fail to adapt quickly to market shifts. Successful basis trading depends on continuous market analysis, managing risks carefully, and understanding the physical logistics involved. Monitoring local cash markets, futures prices, storage costs, and economic signals is key. Traders need to stay alert for unexpected events like supply shocks or demand changes that can break their assumptions. Without this vigilance, relying on the idea that the basis will move predictably can lead to expensive mistakes. So, the main reasons basis traders make costly errors are overconfidence in their forecasts, poor risk controls, and not adjusting to new market realities. Keeping these factors in check is essential for anyone using this advanced trading strategy.